Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Train to record a video basically explaining our TTOS option spreadsheet. That's the Tackle Trading option spreadsheet. This is the latest variation that a good friend and student of ours, Marius, has had the opportunity to take our ideas, our rules, and really kind of put it into a spreadsheet so that people can, start filling out the data, the information, start researching all the positive theta type trades we like to do. Now, to kind of explain a couple things here, on the left hand side of the spreadsheet is the only thing you have to fill out. So where it says symbol, price, month, days till expiration, call option sold, the delta, which is a strike price delta you sold, the credit received. So let's go to a covered call. Let's look at Valero here, and on my other screen that you cannot see, I have Valero written up here, and we're going to go ahead and we're just going to buy it at the current price of 61.08. The month we're trading is October. Days till expiration is 31 days. Call option sold is we're going to sell the 62.5 call option. That is the delta closest to 0.40, which the delta is 0.43, and you can get right around a $2 credit for that. Now, once you've filled out just that data, and you can see all the rules down here under the trade identification, here's where it fills out everything else. Now, your max profit is the profit you have at if you get exercised. And so if you get exercised, you're going to make $3.42. Now, we only sold $2 in terms of the credit, but we're buying the stock at 61.08. We're selling the call option at 62.5. So your max profit is $3.42 a share. Now, your credit ROI, that is the return on investment on the call option sold. So if you take $2 divided by your price in terms of getting in, 61.08, you're going to make 3.3%. Now, your standard credit ROI is 3.2%. The reason this is different, ladies and gentlemen, is this is based on 30 days. Now, this is based on the days we sold till expiration, 31 days. So if we waited till tomorrow, your standard 30-day return on investment would be 3.2%. Since we're selling 31%, 31 days, this is 3.3%. And that standard credit ROI, if you hover up around here, 2 to 4% is average. That's really kind of the ballpark. 3% is really good. Anything above 4% is really good as well. Now, your max ROI, that is a 5.6% if you get exercised at expiration, meaning the stock is above 62.5. Now, your credit ROID. ROID is an indicator that I personally created. ROID stands for return on investment divided by delta. And so the ROI simply takes into account what you sold, your credit divided by your investment on the stock price. This takes into account the delta you sold as well, because not every credit is created equal. Not every ROI is created equal. It depends on the delta you really sell. And this is a 7.6%. Now, that's on the credit ROI, which takes into account 31 days. The one you really want to look at is here on the standard ROI. Anything above 7% on the standard credit ROID is awesome. And at this point, 7.4%, that is absolutely fantastic. The max ROID is if you get filled at expiration. So obviously, based on this data, a covered call would be legitimate on a company like Valero. If we're looking at another company here, let's go Disney. DIS. And once again, on my other screen here, I'm going to go ahead and say Disney. And we're going to buy Disney at its current stock price above at 103.14. Now, that is color coded pink, just to remind you that typically when a stock gets above $100, you might want to look at some other type of trades, but cover call is still perfectly fine there. We're still looking at October, still looking at 31 days. Call option delta, we're going to sell as the 105 strike price. That is the closest strike price to 0.40. The delta is 0.41, and the credit received is $2.15. Now, kind of here, your credit ROI is 2.1%. Your standard credit ROI, which is the one you really kind of want to fixate on, is right at the very bottom of average. So you got 2% standard credit ROI. That is at the bottom. You can do it, but under 2, remember, that is a no-go. Over here, coming to the credit ROI, that is a 4.9%, which is under 5% is a no-go for us. So if we're looking at a cover call on Disney right now, we probably wouldn't want to do a cover call on Disney. We're not getting the rate of return for the delta, especially in comparison to something like a Valero, where you're getting a good ROI, you're getting a good ROI. Everything is really good on that. So that's kind of how you fill out the covered call. This is a very simple way to research covered calls. Now, coming over here to the naked puts. Let's say, like Gino Poor and myself at Tackle Trading, we all love naked puts on the commodities, USO, UNG, SLV, and all we got to do here is, once again, we got to fill out the information here. So let's go ahead and let's look at that USO trade. And so USO, the current price is $14.41. The ATR, because we got to know our range, the ATR on USO is currently 79 cents. And so let's go 79 cents. The month we're looking at sell in October. Okay, the days till expiration once again is 31. We're going to sell the delta closest to 0.20. That is the 12.5, not 120.5. That is the 12.5 strike price. The delta that we're going to sell is 0.16. 0.16. The net credit we're going to receive per contract is 20 cents. The buying power effect on, and I might need to change that to $20. The buying power effect, just do it per contract. The buying power effect is going to be right around, in terms of that, we're getting $19 on the trade. Buying power effect is going to be right around $120. So we put $120, and we do have to change that to the actual credit we're receiving of $20. So here the ROI is 16.7%. The standard ROI we're looking at above 15 is really good. That is 16.1%. 5 to 10% is really kind of in the average range. Under 5% on the naked put is the no-go. So this obviously meets our standard there. Now the standard ROID here over 50% is fantastic. USO is a great covered call naked put covered call stock. So obviously that's going to fit those parameters. Here's what I want to point out is the alert. The alert is based on 1/2 ATR above the strike price you sold. If you never want to buy USO, if it gets below $12.90, you have to make a decision to get out of the trade. You have to make a decision to manage the trade. Because if it goes underneath 12.5, you might have to buy USO at 12.5. Now maybe you want to do that, and that's perfectly fine as well. All I'm saying here is that this will tell you where you need to manage the trade at. And so that's kind of what you have to do on like say naked puts. So for example, if we want to do a naked put on Microsoft here, let's go ahead and look at Microsoft, MSFT. And I'm looking at my other monitor. It's being a little slow. So let's just fill out Microsoft here. So we got 43.89. 43.89. The ATR on Microsoft is right at $1.20. $1.20. Everything's a little bit more volatile right now. Days till expiration 31. The strike price we're going to sell is the 20 delta, which is 0.20. And that is 0.20 on the delta we're selling. The strike price that leads us to a conclusion to sell is the 41. The net credit on the 41 is we're going to receive $44. The buying power effect, you just got to right click on that, go to up to sell single and see how much it is to sell a single contract. And the buying power effect is $589 there, $589. Now, as you can see here, the ROI is 7.5%. It's still fairly decent. Your standard ROI, that's an average standard ROI, nothing wrong with it. And then your standard ROID is right there in the average. So obviously I love the USO one. USO is a little bit more volatile than Microsoft, but that's how you kind of do your research, run your numbers. That's what the standard ROID is. Once again, it takes relative to 30 days per month. That's what we want to look at in assessing the ROID. ROID is once again return on investment over delta. Standard ROI is what we want to look at as well. That is based on 30 days. Obviously, our 31 days out, we're going to have a little bit better on that, but the standard is what we want to look at in determining what a good credit is. These are where you need to manage the position at, and we have this for bull put spreads, you have it for bear call spreads, you have it for iron condors, you have it for short strangles, and then on the far right here you have a resource tab where you have a different couple playlist to watch option videos. This will bring up, a tab here of all the option videos at YouTube. In terms of understanding a lot of the different trades, getting started, different types of tackle trading, articles here, and so you can have some nice little a resource tab to kind of, learn more about trading options, the types of option Greeks, options 101 bid ask, managing credit spreads, naked puts, defining option terminology. Great resource tab there as well. Now, you can get access to, as a tackle trading subscriber and as one of our students, you can get access to all great things that is this spreadsheet. And once again, this is one of the best spreadsheets I've ever been a part of. I like to call it one of my babies there to a certain extent, but you can get access to this over here as a pro member of Tackle Trading and as one of our students at the Tackle Trading website itself. But I hope you've had an enjoyable time watching how to use this spreadsheet. It's how I still research my own credit spreads, my covered calls, my naked puts, my credit spreads, condors, bull puts, bear calls, everything else about that. So I just wanted to take a moment or two kind of showing you how to fill out the spreadsheet and to show you what the standard ROI versus the credit ROI is. Just hover the information. It'll tell you which one's good, which one's average, which one's a no-go, and get in the game one trade at a time. Tackle trading.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.